On the Investing Markets and Money podcast today, we're talking about investment trusts, and this is actually a follow-up podcast. Previously, we have talked about the Majedie Investment Trust, which you can go and look up earlier on in this series. But today, we're actually going to be talking about the special investments part of that trust, which is one of the factors that I think makes it relatively unique. And on the podcast to talk to us today, we have Arjun Menon, who's joining us from Marylebone Partners, which is the trust's investment advisor. And we're going to be talking a little bit more about special investments, what they are, how they work, and how they contribute to the trust performance. So welcome to the podcast, Arjun.
Thank you, Stuart.
So for those not familiar, they can always go and look up the previous podcast we've done on Majedie, but can you just provide a brief overview of how the investment trust's portfolio is managed?
Sure. Yeah. So, Marylebone Partners, we were appointed as the managers of Majedie Investment Trust at the end of 2022. We officially took over from early 2023. And in terms of our approach to running the Majedie portfolio, you might have heard us use this phrase in the past, liquid endowment model. And as you said, for your listeners who haven't already done so, I would highly encourage them to go back a few months and listen to the podcast you did with Dan Higgins, our CIO, as he gives a really good overview of the investment trust overall. But essentially, what we mean when we say liquid endowment model is we're focused on opportunities which are not super illiquid. So we're not doing private equity, we're not doing private credit, infrastructure, or anything that we can't mark to market on at least a quarterly basis. And we take a long-term fundamental view. So, we're not trying to time markets, and we're completely returns focused. Now, the portfolio itself is made up of three buckets. We've got investments in what we would consider world-class third-party external managers. These tend to be managers who, we believe are specialists in their niche areas and often in somewhat structurally inefficient areas. The second bucket is direct equity investments. So these are publicly listed, high-quality companies that we believe are undervalued and that we can invest in directly. And then the third, as you mentioned, is special investments. So these are kind of the more unique, high-conviction opportunities which we source through our external manager network. And in our view, it's that blended strategy that really gives Majedie shareholders access to investments that they normally wouldn't be able to find elsewhere, but still at the same time, balancing risk, liquidity, and of course, return potential.
The special investments, let's define what those are specifically. We'll go into a little bit more detail on that later on in the podcast, but what are the sort of criteria you look for when you're looking at special investments? And also, what sort of weighting in the portfolio would they tend to occupy?
Sure. So for any of our special investments, we basically have three key criteria that they must meet in order for us to even consider taking it forward. The first is that it has to come from a trusted source. So that means that anyone who's bringing us an idea has to be known to us and have something at stake or some form of skin in the game, really. The second is that it has to offer return potential of at least 20% IRR. And then the third is that we have to see a path to exit within 36 months. So, as I mentioned, we're not doing the private equity style 5 to 7 year lockup, illiquid stuff. We really need to see that route to exit within 3 years. And if an idea meets these three criteria, then we can really dig in and kick the tires on the thesis. But anything that doesn't meet all three of those criteria is just a quick and easy no for us. And then the ones that we do invest in, they're all independently marked to market on a quarterly basis. On a quarterly basis at a minimum, I should say, because a lot of them are actually being done a lot more frequently than that. And in terms of the weightings, so currently special investment makes up about 15% of the portfolio. And we have a target of getting that to about 20% over time. So overall, our target weightings are 60% in managers, 20% in direct equities, and then 20% in those special investments. But I just want to stress, we're not going to force our way there. These ideas really do need to be very high quality. We need to, we turn down, I think for every one idea that we do, we turn down maybe 7 or 8 that we look at. So we're really turning over a lot of ideas, and we're actually turning down a lot of ideas.
So given your criteria, from a layman's perspective, it sounds like these sorts of deals should be quite rare. But from what you're saying, you actually do see quite a few crossing your desk on a month-to-month basis?
We certainly do. I mean, I'd say it comes from that sort of robust pipeline of ideas. It just comes from our manager network. So we're constantly out there speaking to managers all the time and always on the lookout for these co-investment ideas. But just because somebody has the idea doesn't mean that it necessarily passes all of our checks.
Understood. And now I just wanted to get into what these kinds of investments look like. Can you give us a couple of examples of successful investments you've had in this part of the portfolio?
Sure. Yeah, I'd be very happy to talk through some specifics. So one type of investment profile that we come across fairly often actually is activist campaigns. So, this is somewhere where we know the activists and where we have confidence in their abilities in that particular sector. And one example of that, a live example actually, is Portillo's, which is a well-known Chicago-based restaurant chain famous for, Chicago street food. And the ticker is PTLO on that one. And that idea was brought to us by a US-based activist manager called Engaged Capital, who we've known for many, many years, and we've done co-investments with in the past. And we're invested in their main fund as well, so we have a really deep understanding of how they operate. And we know that they have strong pattern recognition in the consumer space, particularly with US restaurants. In fact, they were the ones that brought us the Shake Shack co-investment opportunity back in 2023, which some of our shareholders might be familiar with. And if you look at the share price performance there, it saw a very quick turnaround with strong positive returns. But with Portillo's, we invested in mid-2024. And the idea was essentially that this was a company that had been a market darling at IPO, and it was priced for extremely strong growth. But then the shares started to sell off quite significantly, driven by a combination of industry-wide concerns, notably, weak traffic, competitive pricing, ingredient inflation, wage inflation, just a whole lot of headwinds facing the whole industry, but also company-specific concerns. So mainly that new restaurants wouldn't enjoy the same strong returns on capital as existing restaurants had in the past. And then I should also mention the sell-off was partly exacerbated by a clumsy sell-down by private equity backers as well. But it was at that point that Engage saw an opportunity to get involved and push to firstly just kind of improve operations, stuff we've seen them do before, mostly things like tightening up the menus, improving drive-through efficiency, introducing ordering at kiosks instead of at the table, all that kind of stuff that really just improves efficiency and has the potential to enhance revenues and reduce costs. And again, we've observed and seen them do this with other restaurant chains in the past. And then on top of that, they also saw scope to reduce the CapEx for new stores and improve the ROIC. So currently, if you look at Portillo stores, a lot of them are just unnecessarily large. And Engage believe that they can improve the ROIC for new units by shrinking their footprint and basically making them more efficient. So you end up with this very unique, sort of interesting situation where the market seems to believe that new stores, which are being opened in the southern states or the so-called Sun Belt region, will be significantly dilutive to returns, whereas Engage believe if they implement the right changes, this expansion doesn't have to be dilutive and actually it can be quite accretive. So they're working in the background to upgrade the management team, the board, and just general communications with the market. And in terms of returns and timeline on this one, Engage believe that with all of these changes, the stock could more than double within two to 3 years from where we first invested. But again, I just want to stress, it's very much a live situation. It's still playing out. And so with that will come some volatility. And if you look at the stock over the past year, it's really jumped around a lot. But, we're still in the early stages of change. And with any activist campaign, you really have to give it the time and patience it needs for the changes to take hold to make a difference. But I want to bring it back to those 3 criteria I mentioned. Is it a trusted source? Yes. We're invested in Engage Capital's main fund. We've done similar co-investments with them in the past. Does it meet the 20% IRR threshold? Yes, it does. As I mentioned, they see scope for it to double within 2 to 3 years. And then can it be monetized within 36 months? Again, yes, it's a publicly listed stock and Engage are driving the agenda.
That sounds very interesting indeed. And you were going to mention another opportunity that you've been provided with recently?
Yes, yeah, I was thinking something slightly different, actually. Another example of a special investment that we did in early 2023, and we're fully out of it now. But this was the senior non-preferred MREL bonds of Metro Bank, the UK challenger bank. And I know that's that's quite a mouthful, but these are basically bonds which sit at the top of the capital stack of Metro Bank, and they're subject to banking regulatory capital rules, which basically provides an impetus for the bank to call them, or in other words, repay them a year before maturity. And I think this is a good example of one where things don't always go exactly to plan, but it highlights the importance of our process and how we were still able to actually generate a very positive outcome from this investment. So this was an idea that was brought to us by Caius Capital, a fund that specializes in these kind of stressed credit situations and has a very strong track record in the financial sector specifically. And we were introduced to them through a former colleague. And in fact, our CIO, Dan, has also known their founder, Antonio Batista, from his previous firm. So certainly known to us in different ways. But Metro Bank itself was a bit of a turnaround story. And it was working its way to becoming profitable again after various issues in previous years. But since we were investing in the credit rather than the equity, we were somewhat more protected, as the bank would have to destroy a lot of value before our bonds were actually at risk of being impaired. So, when we got involved, the bonds were trading at around 80 pence on the pound, and the market just didn't seem to believe that this bank would be able to resolve its capital issues, either by increasing its profitability or even through an external capital raise of some sort. And so we were able to pick up the bonds when they were trading at a significant discount to par. And all of this is despite the fact that they actually had a 9.5% coupon. So clearly investors were concerned. And the crux of the thesis was just that the bank would work its way back to being profitable. And by October 2024, which was the call date for the bonds, and more than a year since our initial investment, they would have shown 6 to 7 quarters of profitability, making an equity or debt raise to refinance our bonds pretty straightforward by that time. But with all of our special investments prior to investing, we spend a significant amount of time walking through the downside scenarios. And we concluded that at this level of the capital structure, we were sufficiently protected and should still see potential for adequate returns, even if things don't go exactly to plan. And actually, even more importantly, we spent a lot of time understanding Caius's experience in such situations, and we were able to build confidence in their ability to drive a positive outcome and protect on the downside. And of course, that was particularly important in this case because fast forward to the end of 2023, and despite the bank having actually progressed quite well on its path to profitability, there had been some missteps from the management team, and that meant that the bank was forced to accelerate the process of resolving its capital constraints. And that just sent the bonds spiraling. They went from the 80s into the low 50s at one point. So, investors were truly panicking at that point. And I'll spare you the technical details, but as anyone who's ever looked at banks will tell you, when things go wrong, they can go very, very wrong very, very fast. So I think it was over the course of a single weekend, we saw everything come to a head with Metro Bank raising additional capital and refinancing existing debt, including our bonds. But thanks to the swift actions taken by Caius and the role that they had played in structuring the refinancing, our bonds weren't actually impaired at all. And about 12 months later, we were trading back at par. So, obviously in this case, the thesis didn't play out exactly as we had expected, but thanks to the focus on the downside assessment and working with a high quality sponsor in Caius, we were actually able to exit the investment in 19 months or so with an IRR of above 25%. But again, bringing it back to those core 3 criteria, was it a trusted source? Yes, we were introduced by someone who we knew well, and our CIO knew their founder as well. Did it meet the 20% IRR threshold? It certainly did. And then could it be monetized within 36 months? Again, yes, because the bonds were publicly listed.
If I talk about asset class briefly, if we look at the special situations, do they tend to be listed equity and bonds for the most part, or is it really a kaleidoscope of different asset classes?
I'd say it's really a kaleidoscope of different things. Naturally, you get more equity and fixed income related ideas just because we speak to a lot of managers who operate in capital markets, but theoretically, anything that fits within those 3 criteria could fit within the special investments category.
Going back to what you've said earlier, to be able to run something like this, it sounds like network is everything. Knowledge of the other managers in the space, knowledge of individuals who move around between funds, and a knowledge of the sort of reputation of asset management teams. It's almost a full-time job in itself, building and maintaining a network like that.
Exactly. I mean, to be honest, I think having that focus on external managers really helps with that, because we're constantly being shown new managers. We're constantly being able to see where, as you said, high quality individuals, as they move on or start their own things, we have that relationship with them, and so it's an ever expanding network. But at the same time, we're focused on expanding that network as well. Just kind of keeping an eye on where people are, who's doing what. And we're always open to speaking to managers that we've are somewhere in our network that we know.
How frequently will you be marking these sorts of investments to market? And just as importantly, how do they impact the overall liquidity of the fund, and how do you stay on top of that?
Well, so that's kind of one of the key benefits of this liquid endowment model, right? All of our investments are independently priced, at least quarterly, with most assets actually being valued monthly or even daily. And in terms of liquidity management, we try to take a fairly balanced approach. So the majority of our overall portfolio remains highly liquid, and that just allows us to adjust exposures as needed, and whatever things change. And then the special investments are strategically sized to prevent any sort of overconcentration. So they do tend to have slightly longer holding periods, but in no way would I say that represents liquidity risk. Typically, I'd say the longer holding period is probably driven more by the investment thesis rather than the lack of liquidity. So we spoke about the activist scenario, for example. Over there, we want to allow sufficient time for the thesis to unfold and for the activist actions to actually have an impact.
And in terms of the aggregate weight of special investments in the portfolio, what is that? And is it fair to say that you have been gradually increasing it in order to meet the model you've been targeting since you took over management of the investment trust?
Yeah, I mean, it is one where at the moment, again, it's 15% of the portfolio, and there's a target of getting it to 20% over time. But as you can imagine with these things, we're looking at a lot of ideas. We're not just trying to fill that bucket to 20% as quickly as possible. So it will take a little bit of time to get there. And at the same time, all of them have to be, we have to be able to see a path to exit within 3 years. And so naturally, there's kind of this churn. Ideas come in, ideas go out. And so it does take a little bit of time to actually get it to that 20% point. But for us, maintaining that quality threshold is extremely important. So, we're really not willing to lower the bar at all to force our way up.
Understood. And we've sort of touched on this already, but is it fair to say that a lot of these investments that you've mentioned can be incredibly difficult for the smaller investor, the DIY guy, to be able to access independently?
Definitely. I mean, I think, the reality is that accessing these kinds of investments, it's not just about having capital, but it's about having the right network. It's about having the deep expertise, long-standing relationships that actually allow us to participate in some of these opportunities, especially where capacity can be constrained sometimes. So, we've built that global network. It gives us access to these highly selective institutional grade investments, and it just keeps that pipeline of ideas fresh. And as I mentioned, we're only doing one in every 7 or 8 ideas. So having that robust pipeline is extremely important. And I think hopefully I've highlighted some of this through the examples, but the opportunities really require not just those established relationships to source the quality ideas, but significant scale, given some of the minimum capital commitments for some of these opportunities, specialized expertise, especially for some of the more unique ideas off the beaten path. They can require a degree of industry knowledge, and it just helps to underwrite them more effectively. So, I mean, for example, I used to be a banks analyst in a previous life, so that was very helpful in understanding the Metrobank opportunity when that came about. But through the investment trust format, hopefully we can bring these opportunities to shareholders in a responsible way and give them exposure to some of these investments that they wouldn't normally have access to.
And would you say that this blend of special investments makes the Majedie Investment Trust relatively unique in the marketplace?
Absolutely. I mean, I'd say, again, if we step back for a second and just look at what we've discussed, the entire approach is just grounded in this liquid endowment philosophy, which, is long-term, it's fundamental, maintains liquidity and flexibility. And it's that blended strategy that really sets Majedie apart. it gives shareholders exposure to unique, high-quality opportunities while still balancing risk, liquidity, and ultimately, obviously, return potential. Which, in my view, at least, it's quite different from traditional investment trusts, which might focus on a single asset class or style. So yeah, in short, I certainly think that this mix of the managers, the direct investments, and then those highly selective special investments just makes Majedie a truly distinctive proposition.
Great. Well, thank you very much for coming on the podcast today. And I would encourage any listeners who want to hear a little bit more of an overview about the investment trust. There is a previous episode on our podcast channel. You can listen to that as well. That will explain a little bit more about some of the other elements of the trust as well. But thank you very much indeed for coming on the podcast today, Arjun.
Thanks, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.